Thursday's market closes a down day in the livestock for the most part. Grains ending mixed. Sean Heckett with Heckett Financial Advisors joining us. And boy, it sure felt like we had a little bit of a hangover going after the Fed announcement and what we're looking at going forward for fiscal and monetary policy.
Yeah, I keep thinking that everyone keeps thinking that somehow Fed Chairman Powell is going to wake up and just have an epiphany and change his mind and just turn tail and give everybody what they want, which is a lower, more accommodative Fed. And he keeps coming out with these meetings and says, no, we're serious. We're going to keep doing it. We're getting our hands around inflation. We're not going to stop. And yes, there's going to be economic pain. We understand that, and we're prepared for that. We're just not used to seeing that, Michelle. And I think the markets are starting to sober up, that the dream of the pivot is still out there in the distance and not close enough to make the markets comfortable, especially markets that are more cyclically sensitive to demand.
Which would include the livestock or the meat sector. And is that why the cattle market was down despite the fact that we had a dollar higher cash trade, which usually helps lift the market?
I think it's absolutely impacting the livestock sector for that reason. I think it's also impacting the cotton market for that reason. I mean, the cotton market, the USDA said we have the tightest supplies almost that we've ever seen, and we've been getting crushed in the cotton market. And like we talked about, capital flows and how they view these external factors are so important to how the market trades on a weekly and monthly basis. And right now, the demand fear is winning out over the current fundamental base.
So do you think the meats could set back much farther then or not?
I think cattle can. I think cattle, I mean, we've been worried about cattle for over a month now. We don't think we're done with this correction. We think that that's the market that still has more room to put into the downside. The hog market, we're seeing some really good news coming out of China. Record high pork prices, hog prices have almost doubled there. It looks like they're developing a pretty good pork shortage. So even though demand here might be down, we think it's going to be more than made up from increased exports to China. So we think because of that, the hog market probably not as much, but the cattle market's a domestic situation, and we're just not excited about the prospects for that for the next month or so.
Yeah, and I know China's been pulling pork out of reserves, trying to cool their prices down and buying some U.S. pork, so that's at least good for the longer term. So let's move over to cotton, since you mentioned that market. How much more downside risk is in that market?
If you're looking at the chart, Michelle, we came down to that 85 before we had that big rally on the USDA number that came in shockingly low. I just think there's every reason to think we're going to go down there and retest that area, maybe create some kind of a double bottom. I mean, it just is a magnet, I think, for the market to go to before they may say that we've done enough. Let's spend some time watching how things play out and go from there. But so looking at where we are, I guess majority of the decline is behind us, but probably still a little more further to go, I would say.
Over to the corn market and the wheat market, higher today, and obviously we've been putting in some more premium. How much more do you think we will put in these markets?
I really don't think we can put much more without getting some actual tangible evidence that this is moving to a higher level. At some point, you can worry all you want, you can contemplate all you want, you can imagine all you want, but you at some point have to get the actual evidence that it's happening. And I think until we do, I don't think we're going to get much beyond this 9.5 area on, let's say, Chicago Board of Trade December wheat. I just in the corn market at that $7 overhang level, I think we need more than just a thought process that we might escalate this. We need to see evidence.
Yeah, and we kind of ran up into some chart resistance as well in Chicago there. The funds are short that market, so if there's anyone that could take off, that would be one of them, wouldn't it?
Certainly, there's ammunition there where we don't have ammunition in corn, for example, to do the same thing if they really got a reason. At the same time, we have rallied, $1.50 plus off the lows. That's a pretty good premium over a pretty relatively short period of time. To get that marginal buyer who still hasn't decided to buy in yet, I think he needs to see more. If he's held out this long, Michelle, I think he's going to need to see more to give up his short at this point.
Plus the fact that in the corn, we are seeing a few demand concerns. Ethanol production lower, exports were not that great this morning.
Well, one of the consequences of a dollar soaring higher is that it absolutely makes our prices uncompetitive and it slows it down. Regardless of how tight everything is supposed to be, if you're looking at that dollar taking off and the purchasing power of foreign buyers collapsing, it's just not going to deliver high-end demand side expectations. And the USDA numbers may be overplaying that demand, Michelle. And those ending stocks that look so tight we might find out loosen up here over the next couple of reports showing we're not as tight as we thought. And that's definitely what kind of puts in a top a lot of times in these markets is loss of demand and changing the balance sheet because of that. Supply, we got a long way to go to determine exactly what is, but on the demand side, we're getting tangible evidence it's starting to back off.
Yeah. And the soybean market did not follow corn and wheat as it's done in some of the past sessions. We've kind of run into some chart resistance there as well. Do you see us consolidating for a little while here?
Well, the problem I have with soybeans is that Argentina, which is going through another monetary crisis, two-tier currency exchange system where if you sold your bean meal and sold your bean oil aggressively, they would give you a more attractive currency exchange rate.
Yeah, they're flooding the market, aren't they?
Flooding the market. So when you flood all those derivative products on the market, you don't need to buy U.S. soybeans to crush it into bean oil and bean oil. I think that was an absolute like sledgehammer fundamental change in the market, at least for the short term, that put the brakes on soybeans. And we're going to need that to calm down to get that demand to come back, and hence why we're seeing some weakening demand for U.S. soybeans.
All right. Well, I appreciate your analysis. As always, Sean Hackett with Hackett Financial Advisors.